Okay, so sales of business property. We're gonna come back to that 1250, 1245 issue. So these are called 1231 assets. There's a great chart down here. Hopefully it's not too, I'm gonna write this down. I think this is in your book. So you got, if you have a loss, you're gonna have an ordinary loss. These get the best of both worlds, which means it's gonna offset ordinary income. And there's no limit to it. There's no $3,000 limit. So if you have a loss, it's an ordinary loss. If you have a gain, you may have 1245 gain, 1250 gain, or 1231 gain. We'll go through all of those. All right. So, again, so it depends on some factors. Not quite as many factors as the capital assets, but how we treat it does, whether it's a loss or a gain matters with how we're gonna treat it. If it's a gain, it's easy. If it's a loss, it's easy. It's an ordinary loss, and we're going to, we get to offset ordinary income. So if we had wages of $50,000 and then we had a 1231 ordinary loss of $5,000, we get to offset $5,000. Now we pay tax on $45,000 of income, not $50,000. Okay. If it's a gain, it depends on whether or not it has been depreciated. So remember, if it's land, it's not been depreciated, right? But if it's equipment or a building, it probably has been depreciated. And even if it hasn't been depreciated, it's a depreciation allowed or allowable. So if we should have taken depreciation, we still have to, include that in our calculation. All right, and if it's been depreciated, then whether or not it's real property or personal property, okay? Okay, so again, we're gonna net them. So if a net 1231 gain, and so these are net amounts, net 1231 gain results, it is taxed as a long-term capital gain, but it is subject to those depreciation recapture rules that we talked about, okay? So 1231 long-term capital gain, this is how it's treated. So it's gonna get those special rates, but we may have depreciation recapture. If we have a loss, it's treated as an ordinary loss. Doesn't matter if we depreciated it or not. We get to offset ordinary income with that loss. And again, there's no $3,000 limit. Okay. We'll come through to the 1245 and 1250 as well. So let's look at this example. So Yen sold land using a trader business for $15,000 in 2022. It's land, so it wouldn't have been depreciated. He had purchased the land in 1992 for $7,000, so he's got an $8,000 gain there. This is a 1231 gain, okay? And that $8,000 would be netted with any other 1231 losses. That's going to be transferred then to Schedule D. I don't know if they put Schedule D up here as well. So it's going to go on the 4797 on page 2, and you'll see gain from disposition of property. Well, this is 1245 and 1250. So this is Schedule D up here. So if there is a net gain, the gain is treated as a capital gain. Again, subject to any recapture, that's gonna be on, it's gonna end up on Schedule D as a capital gain. If it's a loss, then it's gonna show up on Form 4797 and eventually flow through to line 4 of Schedule 1. All right, so this recapture, we got the concept of the recapture, right? So it's the recovery of any depreciation that had been taken. So for personal property, 1245, so this is personal. This is not personal use, but personal. This is real property. Again, real estate, okay? For personal property used in business, the gain attributable to depreciation is taxed as ordinary income. So, that depreciation recapture so it's taxed at ordinary tax rates. For the real property, the 1250, the depreciation recapture is taxed at the 25%. So the difference between this is gonna be at whatever your ordinary tax rate is. So if you're in the 22% tax bracket, it's gonna be taxed at 22%. I don't know what the tax brackets are these days. The 28% tax bracket will be taxed at 28%. It just depends, it's an individual. This is a flat 25% rate for the depreciation recapture portion. Okay? Again, so 1231 is land. Land is not gonna be depreciated. So this is easy. Any of those losses, you get to offset other ordinary income. That 1245 recapture, again, it works the same as the 1250 recapture. It's just that the tax rate is different. This is an example of what that looks like. So we've got a truck here, cost $10,000, took $6,160 of depreciation. So our adjusted basis was $3,840. We sold it for $7,000. It didn't appreciate at all, right? Trucks generally don't. So all of that realized gain is going to be 1245 gain. So it's gonna be depreciation recapture. It's gonna be taxed at whatever our ordinary tax rate is. So let's take a look at this example here. Nor purchased equipment costing $12,000 for business use. Depreciation deducted on the equipment was $7,392. Adjusted basis then is $4,608. So we got 3 different scenarios here for different amounts. So if our adjusted basis doesn't change. If he sold it for $13,000, well, he purchased it. The easy thing to do to figure out how much is depreciation and how much is appreciation is take the amount realized, subtract what you paid for it. That's appreciation, right? If there's a positive difference. If there's a negative difference, then there's no appreciation. It's all depreciation. So $13,000, but he had purchased it for $12,000, so that means $1,000 of it is going to be 1231 gain, capital gain, right? Due to appreciation. The rest of the gain is going to be recapture. 1245 recapture because it's personal property. It's equipment. Second scenario, $9,000. So he's got a loss, so we're not going to have any 1231 gain here, nothing. We have $4,608 is our adjusted basis. We still have a gain though, because the difference between this and this is our gain. All of that is going to be 1245 recapture. So it's gonna be whatever our tax rate is. $4,000, now, we actually have a loss. Because, I mean, a real loss, because we're getting 4,000 from it. Our adjusted basis is 4,608, so we have a $608 loss. That gets to, we get to offset other income with that loss. Okay. Let's see. Oh, when you're calculating QBI, so this is another thing that we have to take into account. So remember we had to subtract that 1/2 of self-employment tax, that 50%. Then we add in any 1245 recapture amount. So any amount that would have been subject to that 25% tax rate. Okay, 1250 recapture, again, this is real property. Depreciation, again, so depreciable real property used in a trade or business that has never been considered 1245 property. All of it. Buildings, residential, non-residential, used in a business or for the production of income. Any gain on 1250 property is considered to be ordinary to the extent that the depreciation taken exceeds straight line depreciation, but we use straight line depreciation. So there's not gonna be any amount taken over straight line depreciation, but the depreciation recapture, the 25% rate, is gonna be used on any depreciation that we took on that property. You guys are all glazed over. All right, let's see here. I want to see if we can. All right, so this is just an example of the 1250 recapture, which we've already kind of beaten that one into submission. All right. One other thing